Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Mangla Malu and Pavitra Pari. Good morning. Good morning. Well, record highs yet again, right? On the Nifty and the Sensex, on the Nifty bag. And there has been a bit of a reversal in the sentiment. So yesterday we were fretting about the COVID protests in China, the impact it's going to have, the strategy that the authorities take in China. Are we going to see fresh lockdowns? There was a lot of, concern. Investors were a bit jittery. But just take a look at Asian markets this morning. Hang Seng has raced away to a more than 4% rally. The Chinese markets have rebounded smartly, currently up close to about 2.2%. On the sidelines, keep your eye on crude prices. Yesterday, they were decisively lower, closer to that $82.50 per barrel. Now they moved up back above $85 per barrel. So, one of the key drivers of the Indian market outperformance was also the expectation that commodity prices are lower, and they are lower. But it's just that over yesterday, there has been a very sharp increase in crude prices. Hi.
Hi, Reema. Good morning. Hi, Mangalam. So, today, if you look at it, it is really the consumption pack which is doing well. So, a few of those stocks will be up on your screen, the likes of HUL, Marico. I'm just naming a few, but that is the top gaining index right now in terms of sectoral indices. Yesterday, the metals saw quite a beating. So, today, those ones are doing a lot better. They were the underperformers yesterday. Today, those ones are seeing some gains. You have, on the downside, you have Reliance today, which is, seeing a little bit of red. But, of course, for the week, Reliance is still up, around 3.5%. So, we've seen good momentum in that stock. Do keep that one on your radar. And in terms of cues to track, it could be a lot about what's going on globally, because like Reema mentioned, we do have the entire COVID unrest situation playing out in China, so that will be important to watch. You have the Fed chair's speech tomorrow, which of course the markets track very closely, and then we're tracking what's going on with Brent, and also we saw a sharp surge in the dollar index, so that is also something that we will have to watch out for, as far as global cues go. But Mangalam, right now it just seems like there is no stopping this market.
There is no stopping this market, but importantly, there is no stopping, the FMCG pack right now. You spoke about the consumer names. Look at the way HUL is moving, 3.5% on that big boy. We have Britannia, which is picking up. These don't particularly trade at attractive valuations. But for the last 3 months, there has been some underperformance because of the high-cost inventory that these companies were sitting on. The second quarter has ended. Most of them are out of their high-cost inventory. And the second half of this year is where we see demand usually pick up post-festive season, winter, etc. So all these products, which are high margin, usually do well. So everyone who was looking at recovery in consumption in the second half has come back to the market looking literally at any sort of recovery in consumption in the second half of this year itself. And that's what we've seen, in individual stocks as well. But there are stock-specific news pieces as well. Dabur, we understand, is launching a D2C portal. Colgate, we had, Prabha Narasimhan speak to us at the Future Female Forward event, saying that it's been around 3 months for her at the company. But going forward, she is targeting higher market share as well as higher volume. So all these stocks doing extremely well. And yes, no stopping the market.
All right, so we clearly have lots to talk about. Let me run you through everything that we have planned for you over the next 1 hour. The Nifty and Sensex hit fresh record highs in early trade. Mid-caps underperformed today. The FMCG and metals pack lead the charge. Energy and realty drags a little. We'll discuss the way forward for the market with Nilesh Shetty of Quantum Advisors. From the corporate side, Fusion Microfinance will be in focus on the back of its earnings. The lender delivered decent second quarter earnings. We will be joined by the management to discuss more on that and the outlook going forward. Laurus Labs is losing in trade as Kotak Institutional Equities downgrades the stock to a sell. More details coming up for you in just a bit. The brokerage note will get you all of the highlights in just a bit. AMI Organics is also buzzing in trade as small cap World Fund sells stake in the company. Details are lined up for you later on the show as well. And S&P slashes India's GDP growth forecast for the current financial year by 30 bips to 7% and by 50 bips to 6% for FY24. To discuss the latest report in detail, we will be joined by Vishruth Rana of S&P Global Ratings later on the show. So all of this and lots more over the next 60 minutes.
And let's kickstart the show with talking about a few stocks that are buzzing in trade. So AMI Organics higher for the second day in a row. So yesterday there was news about that multi-million euro deal with Fermion, which gives the company some access to intermediaries. But yesterday we also had some interesting block deal on it. Sonal is joining us to give us all the key highlights. Sonal?
Thanks a lot for that. Well, yes, the stock has been buzzing up 4% today, was buzzing yesterday as well. So in the block deal data, we got to know that Small Cap World Fund has sold 12.72 lakh shares of the company at 920 rupees per share. And this is around 3.49% stake in the company as well. Now remember, this particular fund held 4.38% stake as on September quarter. So a big chunk of that holding from this fund has gone away and has been sold to the likes of Norges Bank on account of Government Pension Global Fund. They bought 10.92 lakh shares and ValueQuest Investment Advisors bought 1.8 lakh shares of the company. It has been in focus, as you pointed out yesterday as well, because they signed a multi-ton agreement with Fermion worth multi-million euros. They did not specify the amount that they got from this particular deal, but they say that it will start significantly contributing to revenues from FY24. They've been doing a lot in terms of battery manufacturing, the chemicals for battery manufacturing. So that is the big focus point for the company from here on. So let's see whether this particular deal is in that segment or not, but the stock continues to do well in trade.
All right, take that point, Sonal. Thanks a lot for that. That's about Ami Organics up 4.5% right now. But the one which is losing on the flip side is Laurus Labs on the back of a new Kotak Institutional Equities brokerage note. Nimesh joins in with the details on what he's picked up in this standout brokerage report. Nimesh.
Thanks, Manam. So, Laurus Labs is under pressure today, down 6% after Kotak Institutional Equities downgraded the stock to a sell, and they've sharply cut the target price to 350 now versus 460 earlier. In fact, Kotak believes that Laurus's trouble in the AVR pricing and looming cessation of Plexovid sales are underappreciated by the market. In fact, except Plexovid, the company reported just 19% EBITDA margins in the first half of FY23. While Kotak believes that the volumes can pick up going forward, but the AVR realizations will be under pressure, and the fact that even as Plexovid sales recede, the true extent of margin hit will unravel. So on back of that, Kotak has cut the EPS estimates by 12 to 28% for Laurus Labs between FY23 and FY25, and they've cut now the target price to 350 versus 460 earlier. So big downgrade on Laurus, and that's the reason why that stock is under pressure today, down 6%.
All right, Nimesh, thanks a lot for getting us all of the highlights of this report. The other stock that we're tracking is VA Tech Vibhag. Now, this stock has been surging in trade. It was up around 5% yesterday. For the last 1 month, it's up around 25% as well. In recent news, the company has also secured a 200 crore loan from Asian Development Bank, and their stalled Russia project has actually also resumed its execution. So let's listen in to what Rajneesh Chopra, Global Head of Business Development at VA Tech Vibhag, told us on what is really aiding the company's growth. Listen in.
Russia order, yes, you're absolutely right. In the first quarter, in April, it was suspended, and we were waiting for the next announcement for coming from the client. And in July, the order was resumed. I think we out of units of order worth around 1,300 odd crores, and probably around 1,000 crore yet to be executed. The key highlight is this is an engineering and procurement order. So going forward in H2, we find that this will contribute substantially to our revenue and revenue growth with the H1.
Okay, that is VA Tech Vibhag, a big mover. The management said that the Russian order, which was stalled for so long, has now finally got the green signal. Things have started, progress has started on the execution, and that could contribute nearly 400 to 500 crores of revenues in the second half of this year. So, which is why they're expecting H2 to be significantly better than H1, and that coupled with the decline in commodity prices could boost the margins for VA Tech Vibhag as well. So, very confident about the outlook on the second half of the year. The stock has surged 7%. But let's move on and talk about another important story. Sources say that the government believes the worst may be over as far as fertilizer and gas prices go. They say fertilizer subsidy for the next financial year is likely to be pegged around 1.5 lakh crore rupees. Sapna is here to give us details on this story. Sapna?
Yeah, hi. So exactly the point, the belief in government circles across the board is the fact that the worst may be over as far as the rising, or rather the story fertilizer prices is concerned. If you look at the trend in the last 4 to 6 months, the DAP, the urea, even the spot LNG gas prices, all of them have trended lower southwards. Very clear indication on that. keeping all of this in mind, against what the fertilizer subsidy has been in the current financial year, it's likely to stop at around 2.15 lakh odd crore in terms of the revised estimate of the budget, against 23,000 crores. So for the coming financial year, maybe around 1.50 lakh crore is the number that the government will be looking at, roughly, give and take. It could actually be even lower than 1.5, if this trend basically continues. So, of course, that 73 basic number is out of the window, not just for this year, but maybe even for the next year, because the base is now so high, over 2 lakh odd crores for this year. It's not possible to just cut the subsidy right away. It's already price dependent. So keeping all in mind, maybe around 1.40 to 1.50 is what they will be looking at in FY24.
All right, we take that point. Sapna, thanks a lot for filling us in with those details. Just keep an eye out on Pidilite. That's the other one, which is the latest on the FMCG pack, which is, joining the gainers list right now, currently at the high point of trade. And the biggest reason for that, of course, is the decline that we've seen in crude prices over the last few days. Pidilite is the stock which is currently moved to the high point of trade. We take a short break. On the other side, we'll discuss what's buzzing in the commodity space as we discuss crude. Manisha Gupta joins in. All right, let's welcome the first corporate on Trading Hour, Fusion Microfinance. Remember, the company listed recently. It's in focus. They've managed a good growth in their second quarter, which did help offset some of the concerns on rising NPAs and credit loss. To discuss this, we do have with us the Managing Director and CEO, Devesh Sachdev, joining in. Devesh, thank you for joining in. I was looking at your profits, which got a boost from a 21% growth in interest income, whereas the interest costs increased just by about 10%. Was this on account of the IPO funds that you raised? And in light of that, what's the kind of outlook that you can provide with regards to NIIs, NIMs, the spreads, etc. going forward?
Yeah. So thank you very much for having me on your channel. The IPO money has still not been used because we just concluded IPO in November only. The NIM expansion was already, I think we have been talking about that. If you look at the NIM from Q1 to Q2, now from 9.38 it has moved to 10.21. It is a combination of 2-3 things. I think one, during the COVID we had to do provisioning, so there was an interest reversal, which is now with everything getting normalized. We don't need to do. There's no interest reversals now. The second aspect is the new guidelines which have come up in the microfinance sector, where we can risk the price. Our price can be fixed based on the risk, and we are continuing to grow. So it's a combination of these things where you will see that every quarter the NIM will grow from here, from 10.21 in Q2.
You said that IPO money has not yet been used. Going forward, that will also support your cost of funds. So that means NIMs are likely to grow further. Can you give us a sense how much of that it will be? I mean, by the end of this year, what are you looking at, say, 100 basis points higher, 50 basis points higher? What broad range are you talking about here?
Yeah. So, look, the new rates, we have started disbursing based on the new rates from May. The complete reflection of the NIM will start from Q1 of 2024. But yes, when we use this capital which we've raised, you will see that this margin definitely moving up. But how we are looking at is that maintaining a margin of anywhere between 11.2 to 11.5, and that will start getting reflected in 2024.
You said that there are these new regulations which are helping you price higher based on the risk. Could you elaborate a little bit more on it, and how does that change your business model or the way you, price your loans that you give out?
Yeah. So look, the new regulations have to be looked at from 2-3 angles. So one is that it definitely increases the sustainability of the customer, because now the regulations are uniform. It is applicable on every lender, whether you are a bank or an NBFC or SFB or an NBFC MFI or a small finance bank. So it will make, and then you have to do a credit assessment at a household level, so which will create a sustainability from the client perspective. And definitely it has made a major positive impact on the NBFC MFI, because we are now able to price our risk. So what we have done is that we have categorized our states depending on certain data point on a high and medium and a low risk, and then our rates are ranging between 19% to 22.65% within this range. So yes, what it has helped is that earlier, as you know, the margins were capped at 10%. Now we are in a position to have a margin of around anywhere between 11.3 to 11.5%. This margin expansion of around 1.5%, 1.5 bips will help us in building some extra buffers, which management overlay, which we have already done in this quarter, and give a very consistent ROA and ROEs.
All right, got that. Good morning, Mr. Sachdev. Thanks for joining us. This is Pavitra. I was looking at your AUM growth, which sequentially looks quite good. It's up around 9%. Can you tell us, do you think this is a sustainable run rate going forward, without compromising on the credit quality, or what is the kind of outlook that you would see on the AUM growth?
Yeah, Pavitra, good question. So, if you leave aside, Pavitra, the last 2 years of COVID, we have been very consistent in terms of our disbursement quarter on quarter. You will not find us doing a very lopsided that, most of the disbursement are coming in the last quarter. So if you look at the Q4, from Q4 to even the Q1 of 2022 to Q1 of 2023, the drop is very, it's only minus 3%. So minus 2 to minus 3%. So now every quarter you will see that there will be an increase, but increase will be only in the range of 5 to 8, 5 to 10%. So we are more consistent, we are more calibrated. We would not like to be very aggressively growing. Also, if you look at our average outstanding, our average ticket size, we are very, calibrated. Our average outstanding with the customer has moved 8 to 10% year on year. So we will be growing and progressing in future also with a similar strength, because that's our very key strength.
One thing that confused us was the fact that you're looking at raising 145 crore rupees in terms of funds via NCDs. You just raised 600 crore rupees via fresh issue in the IPO. So why a fundraise in such quick succession? And is it because you're getting attractive rates? What exactly is the rationale here?
Yeah, I think one, it's a common look. So there are two aspects. One, raising debt is one aspect which continue to happen. We went into a discussion with about this prior to our IPO. Also, we are raising some unsecured money, which is going to really help us, because then we will have a asset which will not be tagged. So it's a combination of all these things. It's about rate. It's also about the fact that when we went into discussions, so it's a combination of all these things.
We'll leave it at that. Thank you very much for joining in. That's Fusion Microfinance, optimistic that margins are likely to improve from current levels. From the current 10.1%, it could inch higher to 11.2 to 11.5%. Shift our attention now to the commodity space. Manisha Gupta joins in, and she's going to be talking about zinc. Manisha?
Well, yes, Reema, I'm talking about zinc because we've seen the prices rise quite considerably in the past 1 month. It's up by nearly 9%. And that is because of the uncertainty of the energy supply in Europe, which has led to constant shutdowns or capacity cuts when it comes to production of zinc there. Also, when you look at the zinc global deficit, well, that number seems to be constantly increasing as well. If you start with the Jan to September number, the deficit that we see in the country right now, the global markets that is, at 43,000 tons. August was 101,000, and we have seen September actually see an even higher 103,000 tons of a deficit into the markets. Of course, there is a spike in COVID cases in China, and is the reason you haven't seen the zinc prices run up way much more than you would have expected them to. If you look at the Chinese zinc refined imports, those have constantly declined in the first half of this year. Also, when you look at the latest number that has come in for the month of October, the refined zinc imports into China fell 77% on a month-on-month basis and nearly 97% on an year-on-year basis. That tells you that the kind of demand that China is looking at constantly depleting. But as I said, the only reason that the prices have gained in the last 1 month has been because of the global deficit numbers, which still continue to balloon.
All right, Manisha, thanks a lot for getting us all of the details on what's going on with the zinc prices. But with that, it's time for a short break now. When we return, we'll discuss how you should trade in this market, which is at all-time highs for the second day in a row. We'll get you the market technicals with Mitesh Thakkar of earningswaves.com. Welcome back. You're still tuned into Trading Hour, and let's get you a technical check on this market. Mitesh Thakkar joins us now. Mitesh, good morning. It is another day of records, here in the market. So the Nifty Bank again at fresh all-time highs. How would you approach it now?
Yeah. So I think definitely a very good day, continuation of the up move, which we've been calling for the last few days. And 18,750 now is the target which we're looking at. The good thing which traders can possibly now do is to trail their stop losses just below 18,600. So 18,585 is what I recommend on this spot, and hold on to long positions. Having said that, stock which is giving a breakout is Glenmark. Recommend a buy here with a stop at 434 for targets of 455. And some strong continuation happening on the charts of Hero Motors post that price rise announcement. I think this one should go higher. Buy here with a stop below 2790 for targets of 2920.
All right, take that point. Mitesh, any other individual stocks that you like from the FMCG pack? Because we've been talking from the open of the show itself that, a lot of them are doing well. Is this just a one-day sort of thing, or do you think this is sustainable?
See, FMCG, I think, we had a slightly negative view on a couple of stock names, which is like Marico, Bata, etc. from the longer-term chart point of view. But in the short term, I like Nestle. I think has given a good breakout today. That's a stock which possibly can be bought with a stop below 19,850, just maybe 20-30 points below that. And this could give a good rally trading bump up to about levels of 20,600 at the best. So there's some trading happening on the FMCG side, but it's not looking like something sector which is a secular bull market.
Okay, thank you very much for joining in. Another stock that's on our radar is Dabur. The stock is surging, but even the rest of the FMCG stocks are quite doing well. What's the news on Dabur?
Well, for Dabur, it's no new news, but this is something that everyone knows about and now is betting for that. The fact that they will launch their D2C platform called Dabur Shop. This platform, which is currently in the beta testing mode, will go live across the country by FY23. What does a D2C shop mean? Basically, it is a Dabur Shop website which will be online, and you can go ahead and buy their products, etc. Why is it an important moment for Dabur? Because e-commerce is at 9% of their sales. This was just about 2 to 3% 3 years ago. So that's growing extremely fast. And secondly, new products contribute 11% of sales in e-commerce as against overall, which is around 4 to 5 odd percent. So new products which are higher margin doing well on e-commerce is margin accretive for these companies. And they've launched a bunch of digital brands as well. And they're not the only ones. We have HUL, ITC also having their e-commerce shop, etc. So Dabur is one player which is entering that space now. They are targeting about 100 crore revenue coming in from digital brands, which would be through e-commerce, their offline sales and non-platform sales as well. The big question is how much do they sell via just this platform, and how much incremental revenue comes in from their new products on this platform. So those are a bunch of things we'll be watching out for. But for them, the fact that it is slightly colder now than it would have been same time last year does well for them as well, because all the Chawanprash, etc. sales increase a lot during the winters. Immunity
boosting products, right? That's what Dabur is famous for. They did well in COVID times as well due to these products. As Mangalam has said, it's getting a bit chilly here. Let's get into a break then.
Well, let's do that. We're going to get into a short break now, but when we come back, we're going to continue to focus on the markets. Nilesh Shetty of Quantum Advisors will be with us.
Markets climbing higher and higher. Yesterday, the all-time high, the intraday high was 18,614. We opened slightly below that level, but now look at the way the markets have picked up. 2 hours gone since the markets have opened up for trade, and we've only gone from strength to strength, up 0.5% on the benchmark indices, but the mid-caps are trailing a tad bit. Nilesh Shetty, the portfolio manager at Quantum Advisors, is now joining in to talk about the way forward. Nilesh, that's the question, right? We've got here, we've done absolute outperformance, relative outperformance. What are the triggers for the markets for a further rally from here on? That's point number one. And secondly, we had Rahul Arora of Nirmal Bang earlier today join us on the channel, and he was telling us a lot of fund managers are asking him, what should we sell right now? So they're not convinced about the markets going up from here. Are you also hearing that kind of questions?
No, I mean, for us, we actually remain fairly optimistic. I think in a world which is staring at recession, India will stand out. I think a lot of money will come into India. And it's typically in an economic expansion where analysts are playing catch up to earnings. We've seen last 2 years where analysts were surprised on the upside to the earnings that was delivered. And we think that trend will continue over the next 2-3 years. I think India is in an economic expansion after almost 7 years of downturn from 2013 to 2020. Economic growth continued to surprise on the downside. Perhaps it got elongated because of demonetization, GST, and then COVID, the down cycle. But after that, it looks like a bottom was found somewhere around COVID and the economic up cycle started. And private capex has not even kicked off. So I think with the next 12, if the demand remains strong, you will see private sector announcing new capex and infrastructure projects, which will again create another wave of economic demand. So again, we remain very bullish. We think there is further upside to the market. I think India will stand out and will attract a lot more higher flows. And it's not the time to reduce allocation to equities or reduce exposure to India.
All right. It's not the time to reduce the exposure to India. But at some point, things will turn, right? We are seeing a fair amount of outperformance from Hang Seng in the last couple of days after the underperformance that we saw. So do you think incremental flows which came into India as a result of them moving out of, say, China as well as Hong Kong, etc., will now reverse? Is there a possibility, or the money that stays in India and any other money that comes in will incrementally go to these other places?
Unfortunately, flows did not come to India. This year, still, we are about $18 billion in negative. So what happened was a negative drag that China created in the EM indexes created a sort of backlash against emerging markets, and a lot of fund managers sold out of emerging market indices, which created outflows from India as well. But at least when we interact with a lot of foreign investors, some of our own clients, India is in the top of the mind. A lot of them are wary about China. So you could have tactical trades where people might allocate to China because it has fallen a lot more. But if you're a long-term strategic investor, if you're looking to allocate for the next 5-10 years, I think India is at the top of the mind in terms of one of the top emerging markets that they would want to invest in.
All right, Nilesh, good morning and thanks for joining us. You said that the up move is likely to continue. India is likely to, keep doing better than the rest of the world. What do you think are the sectors or the spaces that are really going to drive this up move? So far, we've seen the financials do very well. The auto pack has done well. Do you think that's a trend that will continue?
Yeah, so I mean, the last decade was clearly a decade for growth stocks, right? So in a low GDP growth environment, companies that were offering slightly higher growth got re-rated quite dramatically compared to the sort of broader economy or stocks linked to the broader economy. Once the economic expansion started, the growth differential narrowed. And in fact, there is now a big question mark on the growth stocks, saying why should they trade at the multiples that they're trading at when the other sectors are doing equally well. So I expect sectors linked to the broad-based economic recovery to do a lot better, including consumer discretionary, two-wheelers, financials. I think they would perhaps lead the next wave of the rally. And some of them have still not moved. Financials have actually underperformed post in the COVID rally. And there is, at least our sense is, there are opportunities emerging there. Was a disappointment of some of the sectors that were re-rated. So we have opportunities emerging in asset management, in insurance. These were sectors which were priced for growth, but the underlying earnings delivery was not there. So that has now created a lot of disappointment, and valuations have come off quite dramatically. So we found stocks in these buckets to add to the portfolio.
You've also started recently increasing your weight in technology, and this is after trimming it through the whole of last year. Could you tell us the reason why?
Again, we are sort of value investors, and given the deep correction that has happened this year, the top names are down anywhere between 25 to 30%, and then the sort of tier 2 names are down 40 to 50%. Now, we think demand will slow down. There would be some impact of demand on these companies. But if you're looking with the next 4-5 year view, the valuations at which they're trading, they look fairly attractive investment opportunities right now. I think if you sort of take away the noise that is around US recession and you look at the hard data and the numbers that these companies are reporting, it's not that bad. it's actually been quite good for these companies. None of the commentary so far has sort of suggested a sharp slowdown. There is some noise about clients rethinking budgets, but as of now, you've not seen any major cuts in budgets. So given the deep correction, we think these companies offer great investment opportunities right now. So we started increasing our weights gradually in the sector.
All right. And your exits are rather interesting because you've exited cement companies and a hospitality name. We can probably assume, guess which hospitality name it would be given the sort of price correction that we've seen in a couple of these stocks. But everyone's hoping for cement to recover just ahead of budget. Everyone talks about this big infra push coming in. At the same time, from a long-term standpoint, mid to long-term standpoint, the hospitality segment in India has, demand-supply dynamics in their favor. So to that extent, what explains this exit? Is it just a near-term exit and then you'll look at better entry levels, or maybe you think everything has been priced in and you just exited because it was all priced in?
Yeah, like you said, when we did the numbers, our sense was what was being priced into the stock was much ahead of underlying fundamentals. When you benchmark these companies on earnings or replacement, they started trading at substantial premium to that. That is what triggered our exit. Even in cement, when we looked at valuations for our holding companies, again, the companies were re-rated because of change of management. But underlying fundamentals have not changed. So for them to trade at twice replacement costs, so even at replacement to make 15% ROEs was a struggle. So at that kind of valuations, even though we have no doubt that the demand will recover and companies' profits will grow, but how much of that was priced in our sense was most of the good news was already in the price, which triggered an exit from our portfolio.
Okay, sorry. Nilesh, we'll leave it to that. Thank you very much for joining in. Get into a short break. Well, the Indian markets have soared to all-time high levels even as S&P has cut India's FY23 GDP forecast by 30 basis points to 7%, and they've also lowered next year's FY24 GDP forecast by 50 basis points to 6%. We'll be joined by Vishruth Rana of S&P Global Ratings to discuss India's GDP forecast and how it compares with the rest of the Asia-Pacific region.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. And now S&P has cut India's FY23 GDP growth forecast by 30 bips. This is to 7%. And for FY24, it has been cut by 50 bips to 6%. In its latest report, it says that the global slowdown will hit the Asia-Pacific region, but it will not halt it. To discuss more on this, we're now joined by Vishruth Rana of S&P Global Ratings. Vishruth, good morning and thanks a lot for joining us. This is Pavitra. So, coming to just the India part of this report first, you have said that, you are trimming the kind of forecast that you have, but it's not likely to halt growth in the region. What are the parts that you see really hold up growth, or what do you see as the sectors that will sort of keep this market afloat?
Yeah, thanks, Pavitra. It's a pleasure to be on the program. And as you mentioned, we're lowering our Asia-Pacific forecast for 2023. This is on a weaker global outlook that we're seeing at the moment. We're expecting this synchronized monetary policy tightening that's going on globally to weigh on growth prospects over 2023 in the US and Europe. We have lower growth forecasts. In Asia-Pacific, there will be this knock-on effect from this weaker external demand. However, we anticipate that the domestic demand, this consumers going out there and spending, that's going to be the strong point for Asia Pacific, for India as well. And really, this is the area that's going to support growth over the next couple of years in the region.
Okay, so India's domestic demand resilience will support growth for the entire Asia-Pacific region. But that said, Vishruth, you've still brought down India's GDP forecast for this year as well as the next fiscal year. Could you tell us the reason why?
Yeah, so there's a couple of factors driving our forecast revision for India for this fiscal year. There's two main reasons. So the first reason is that the April-June quarter saw weak sequential activity, weaker than anticipated, even though there was this strong private consumer activity that I spoke about. But the overall GDP number is slightly lower than our expectations. As a result, there's that base effect pulling down the overall year's number. The second reason, which is also the main driver for fiscal 24's downward revision, is this global slowdown that we are seeing. So we're starting to see that in the numbers as well. Exports activity, trade activity in general is starting to slow down. Industrial production numbers also looking a little bit weaker. And this is, of course, not just an India narrative. This is a region-wide narrative that we're seeing. And as a result, we expect that this external orientation will lead to this slower growth numbers out of India. One interesting point on that is that in recent years, the Indian GDP cycle has been very strongly correlated with the global growth cycle, so an indication of more integration of India's economy with the rest of the world.
Well, we don't know whether that works well for us or not, because at some times not being integrated with the global economy works to our benefit because of the strong domestic demand that we have, and at sometimes it doesn't. Anyway, Vishnu, your thoughts on the way central banks will then behave in light of the kind of growth targets that you've had for Asia Pacific? I mean, we're all looking at the big numbers coming in from the US, but your thoughts in local central banks and the US Fed itself?
Yeah, that is the key question for us at the moment in terms of how central banks are going to respond to this ongoing, this inflationary episode that we are seeing. And there's a number of elements. So let me break down inflation into the two key elements I believe we should be watching out for. So one, on the supply side. So what we saw earlier on this year is oil prices rising quite significantly, and that led to not just energy prices rising, but a wide range of commodities. So there was that supply side push on inflation. Some of that has eased in recent months as oil kind of remains range bound in the $90 to $100 barrel range. So some of that energy price inflation is starting to moderate in year-on-year terms. And then the second part of it is the demand side. So core inflation has been ticking higher, and that's also happening here in India as growth recovers. And the central bank is trying to push back against that, certainly in the US with the Fed. So for the Fed, it's going to be a question of when that cycle turns, when we start to see a slowdown in domestic demand and inflation expectations start to come down. We don't anticipate that will happen until at least mid-2023. So we do anticipate that the Fed will be tightening till then. In India, we expect that the RBI is likely to tighten further. However, the pace of increases are going to be a little bit more gradual as the RBI waits to see whether, what's the effect of the current monetary policy tightening that's already happened. About 200 basis points already this year, so pretty significant. It is going to weigh down on inflation, and as I said, supply side is going to bring down the number a little bit as well.
So how much more by way of rate hikes from the RBI? 190 basis points done so far in this year. What's your expectation?
So Rima, for the end of the year, we have 6.25% as our projection. So we anticipate a material slowdown in the pace of tightening, which works out to another 35 basis points from here. And then after that, we expect that core price pressures are going to start to stabilize. And on the headline side, particularly if next year's monsoon continue to be favorable, we expect food price inflation to moderate. And that will give the RBI some space to to ease policy, so cut interest rates over the course of the 12 months beginning March 2023.
So in the December policy, a 35 basis points rate hike?
Yeah, that's what we are penciled in at the moment.
All right. And then after, in FY24, we will start seeing a rate cutting cycle from the RBI.
Yes, so we expect that we are going to see some easing from there. So, that should hopefully be favorable for financial conditions. On the other hand, the risk to that is, of course, this core inflation story. So if we don't see core inflation start to ease, then the RBI might be pressured to continue tightening policy even from there.
All right, very quickly, what is your outlook on just the core inflation, and how do you see it coming down?
Yeah, so really one of the elements that has been playing into the core inflation story, not just in India but globally, is the wages and the labor market. So the rebound in services that we saw post-pandemic has been one of the key drivers of core inflationary pressures and service market labor pressures. So when we start to see that slowdown in the global economy happen, that's when I start to expect core inflation pressures to ease. So by that metric, probably another 6 months, late H1 2023.
All right, take that point, Vishnu. Thank you so much for joining in and giving us that outlook. As we speak, there is news at the bottom of your screen where US-based crypto exchange Bitfront will cease operations by the end of this year, and this follows a lot of the other crypto-based companies, etc., crypto-based exchanges which have gone into financial difficulties. We take a short break, come back, get you more on the markets on the other side. Well, for the Nifty, it's meandering and consolidating around record highs. We have, frontline index still holding with gains of around 70 to 80 odd points. But in the last 30 odd minutes or so, it hasn't moved much beyond that. So it's important to watch where it goes from here because it's entered congestion zone. At the same time, we have a couple of heavyweights not doing too well. So L&T, for instance, has now moved to the low point of trade. And this even as the mid-cap index is not doing particularly well. The mid-cap index down about 0.25%. We've seen a bunch of stocks decline, but at the same time, a bunch of stocks also doing extremely well. ICICI Pru is the latest entrant on that list, which has currently moved to the high point of trade with a gain of almost 2.5%. Most of the gains coming by in the last 15 odd minutes or so. That's about ICICI Pru. So let's talk about the markets itself. Rahul Arora, the CEO at Nirmal Bang Equities, spoke with us this morning, and this is what he had to say in terms of his opinion on the market and the stocks going ahead. We take that view of his and wrap up on this edition of Trading Hour. Thank you for watching. On the other side, halftime report comes up.
It's very difficult to justify stocks on a one-year forward, confessed as a sell-side, entity. So we've had to roll over valuations just to keep stocks as buys. And that should tell you if the street is doing that. A lot of people are now valuing companies on September 24, which is the midpoint of 24, 25, or they rolled over to 25, which means from a one-year forward at these prices, you're finding it very difficult to justify valuation. I don't think there's going to be too much price-wise damage. Even if you fall a couple of thousand points from here, the kind of monies that have been made in the run from 7.5 to 18.5 has been amazing. But I would say more a range-bound time-wise correction rather than a significant price correction would be my guess. I would avoid anything export related and go overweight on anything domestic related. I think the time to buy IT services will come. They're fantastic businesses, great cash flows, great dividend yields on them. But my sense is that they haven't called out the slowdown in the greater part of their businesses. The fact that we're heading into an pre-election year, I think cement, banks, the Prime Minister has spoken a lot about defense. That could be an interesting play. And maybe as a second or third order beneficiary, maybe something like an FMCG could make a comeback, which has seen both time-wise, price-wise correction and a technical factor. It's relatively under-owned. Nobody's over-owned on the consumer staples at this point.